Welcome to Fear and Greed, the week ahead. This is where we take a look at the big events, reports and releases coming up this week that give insight into the economy and a look back at what happened last week too. I'm Sean Aylmer, and every Monday I'm joined for the week ahead by economist Stephen Koukoulas. You'll find him at thekouk.com, thekouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
Good morning, Sean.
Well, we've just come off a pretty big week all in all. How can you have an unemployment rate of 4.6% and be so down in the mouth about it?
Yeah, it's this quirk that we saw unfold in the middle of the lockdown last year, where the Bureau of Statistics asked people, are you still employed? And people are saying yes. Then they next ask, how many hours did you work? Well, with the lockdowns in hospitalities, 0. So that 4.6 unemployment rate was actually heavily distorted by the fact that we had something like 125,000 people who were counted as employed, but alas, they didn't work any hours at all. So a couple of other smart people have crunched the numbers on the labour force. In fact, the true unemployment rate's probably around about 5.5%.
Okay, and likely that we're going to see a lot of job losses over the next couple of months, given what's happening in your hometown of Canberra, also Victoria and New South Wales.
Yes, there are job losses. Now, that quirk in the numbers was really just for the month of July, remember, too. And the survey that the Bureau of Stats do is in the first 2 weeks of each calendar month. So it really didn't capture the full extent of these lockdowns and shutdowns and, the broadening of the geography, I suppose, that the lockdowns is taking effect. So the next few months, you're quite right. We will see unemployment spike up, notwithstanding this quirk in the numbers. And I think a lot of people are looking at something near 6% for the unemployment rate once we get the September, October and November numbers. And that's with employment going backwards by several 100,000. That's obvious, I think, with the lockdowns that's occurring. And it's requiring, I guess, a reassessment from the market about where some of the risks are, because again, just recently, a month or two ago, there was this reflation trade. Bond yields were tending to go up rather than down. The Aussie dollar was going up rather than down. This week, the Aussie dollar's below 72 cents as we kick off the new week, and bond yields are remarkably close to 1%.
Yeah, and last week equity markets certainly came off around the globe, but not as much in Australia, but certainly broadly the sentiment seems to have turned a little bit more pessimistic.
It has, and I think it's the Delta variant globally that's having an impact on expectations about the growth outlook. And while there's still some decent numbers coming in the global economy, you have the US economy is doing pretty well, China's growing, it's come off the boil, obviously. But nonetheless, there's still reasonable growth numbers out there, but there's just this concern that if this Delta variant turns into what's after Delta, Gamma, Epsilon, whatever the next great letter is, we will have another serious health crisis, and we know what happens to economics when the health crises come along. So that's the economic game at the moment. What's happening on the health front is determining what's happening in economics and, to some extent, markets.
And one that didn't get a lot of airplay last week outside the economics community was the wages figure, and that was very low.
Oh, yeah, well, we had 2 wages figures last week. One was the wage price index, which is the sort of purer measure of wages because it's what firms are paying for a constant job. And it was only up 1.7% through the year, so a really low rate. But arguably more important were the average weekly earnings numbers, which are actually the dollars and cents that get paid to people. Yeah. So in a sense, you can have a very different result for both wage series. But the AWE numbers actually count whether you've got a promotion, whether you're working fewer or more hours, those sorts of things. And it actually showed that in the year to May, wages rose by 0.1%.
Yeah.
That's in nominal terms. You look at the core inflation rate, about 1.75%. Real wages are really being hit and going backwards right now.
That was last week. In a moment, I'll be back with Stephen Koukoulas to talk about what's coming up this week. I'm with economist Stephen Koukoulas, aka The Kouk. Stephen, capital expenditure figures this week.
Really important numbers. One of the missing ingredients for the last 5 or 6 years has been a lift in private sector capex. This is despite the government having accelerated depreciation allowances and other incentives, and of course low interest rates, usually a precursor to a lift in capex. Now, last quarter, the March quarter, we saw a strong 6% lift in capex. This quarter, which is the June quarter, pre-lockdowns, it must be noted, we're looking for another decent rise in business investment. If the NAB survey measures through to the June quarter anything to go by, and I think they are, we're likely to see the CapEx turning point happening really quite clearly in these numbers. Of course, We do have to watch them with a degree of caution. The lockdowns, the dominant issue at the moment. But as we got into these lockdowns, it's safe to say that the private sector business investment climate was looking pretty good.
Tell you what, if you've got interest rates where they are and the handouts from government and you're a business and you're not actually investing, you got to wonder what your future is.
Indeed, and this is a great opportunity. And in fact, a lot of the investment too is just adapting to COVID change.
Yeah,
We've seen that adaptability and things that were happening anyway in terms of online distribution and all the logistics of getting stuff to people's homes was happening anyway.
Yeah.
But COVID's really sped that up.
I think it's really important that CapEx isn't just about investing in buying a new building or another company. It's all those little things that people spend money on to change their business.
Oh, indeed. And if you look at the details of the CapEx survey, it is IT services as well as the computer equipment and machinery. It's developing websites and these sorts of things. That's business investment. That is sort of not just the proverbial lathe, a truck and a building, which we used to think about as, and it still is CapEx. Obviously, you need buildings and trucks and things too. That's still part of it. But increasingly with the technological revolution of the last few decades, that increasingly we look at the development of IT systems and keeping up, I suppose, with the systems as part of that CapEx.
Yeah, I mean, construction work as well, although that is June quarter, should be okay, that one?
Should be good. We're building a lot of houses at the moment, so that's pretty good. We know that the infrastructure spending's rolling along at a reasonable clip too, although some projects are starting to come to an end. But for the June quarter numbers this week, the construction numbers again should be positive, which is really important because next week we've got the GDP numbers on the 3rd of September, I think it is. And this is sort of the building blocks into what that June quarter GDP number is going to be.
Okay, and just quickly, retail trade out this week as well for July.
Yeah, that's a shocker. That's the July number. Again, really important to look at the reference period for these ABS data. We do know that the lockdowns in New South Wales were intensifying during the course of July. Victoria was being hit. Southern Queensland, we know, was being hit a little bit. So the card data that a lot of the banks are using now to try to second guess what the retail sales numbers are, and they're pretty good, it must be said. They're looking for a fall of around 1.5%, maybe even 2% for retail spending in the month of July. And of course, that is the precursor for what will be a really weak September quarter GDP number. We know that's almost a given.
Stephen, enjoy your week.
Thanks, Sean. Busy week ahead.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.